The broadcast is now starting. All attendees are in listen-only mode.
Assalamu alaikum to all of you, and a very good evening from my side. Today is day 3 for this practice to pass session of the paper F8. In the previous classes, we have covered few IFRSs that includes IS 16, IS 38, IS 2, IS 20. Then we have covered IFRS 16 and IS 40, IFRS 5, IS 41. And in the last session, we have just started this topic, that is revenues, IFRS 15. So before starting this session, I want to know your feedback about these sessions. What do you think that these sessions are useful for you guys? Is it increasing the confidence towards the examination? Is it beneficial for your concepts? What's your opinion about this? Please give your valuable feedback. Yeah, Alhamdulillah, the students are giving a positive response about these sessions. And believe me, my special focus will be on those students who previously got flunked in this paper. So if you follow my special plan, as you all know that I have shared a special plan on the WhatsApp group as well. And those who have not yet joined the WhatsApp group, please join the group, or you can contact me on my number. And I'll be available till the exam date. You can ask any of the concepts after these sessions. My last session will be on the Friday. Then after Friday, you'll be able to ask any sort of questions. You can even call me. You can even call me if you have any doubts in your, because there are a lot of discussions going on in the group. So I will not be able to catch your queries on the group. So if you wanted to ask anything personally, you can message me, but it should be after Friday, because I have a very hectic schedule till Friday. Yeah, it was, Fatma, it was a mistake in, I think, one of the questions that shows that the recoverable amount is the lower of net selling price and value. The answer for that question is actually A. Which is the recoverable amount should be the higher of rather than the lower of. So it was just a mistake. So for the repeaters, if you follow all my guidelines, believe me, you will definitely pass the paper with very good marks and this session. So my plan, special plan, is very important for those who got flunked previously. And it's my request to all of you to do focus on the concepts more rather than on the weightage. So if you have done more than 1,000 questions, but you are weak in the concepts, so comparatively, it's not that beneficial for you as compared to if you have got practice, if you have done the practice of 8 to 10 questions per accounting standard, but you have got the sound concepts of that IFRS. The application of the IFRS is actually the prime objective of this paper. For the yesterday homework, I will share the answers today. So let's start the session. So we have covered this financing element concept in the last class, and the allocation of the price for the bundle transaction. Now here comes the construction contract. Here comes the construction contract. This part is related to the construction contract, in which you are required to recognize the revenue, the related cost of the construction, and the profits based on the percentage completion, which could be work certified approach, or it could, but the percentage could be based on the cost approach. The question will tell you about which approach you have to follow. So if it is work certified approach, then the formula will be work certified to date divided by contract price. So work certified approach is actually revenue based percentage mechanism, and cost based approach is related to the cost incurred to date divided by total cost. So work certified approach will focus on the revenue side, and the cost approach will focus on the cost incurred to date. So these are the two mechanisms through which you can calculate the percentage of the completion of the contract. If the contract is 50% complete, then you can book the 50% revenue, 50% cost, and 50% profit. So for all the construction contracts, first you need to find out the total revenue of the contract, total cost of the contract, and total profit of the contract. This is the first step for all the construction contract questions. The second step to identify the percentage completion, which could be in some questions based on the work certified approach, and in some questions will be based on the cost based approach. And by using the formula, you have to calculate the percentage and apply that percentage on these total figures. So if my contract is 50% completed, then I can recognize 50% revenue, 50% cost, and 50% profit. Cost to complete in the ACCA, yes, it should be the balancing figure, or even you can apply a percentage directly on the questions in the examination. So let's start this one, solving this question. Now, first of all, when you read the contract, first you need to identify the total price of the contract, total cost, and total profit. So you can see the total price of the contract is 500,000. Cost to date is 3 lakh, and estimated cost to complete is 100,000. The total cost that you need to incur in order to complete the contract will be 4 lakh, and the total profit will be 1 lakh. Value of the work certified to date will be 400,000. The stage of completion will be estimated using the cost value, input, or sales value. So you need to solve this question first using the cost approach and then using the sales approach. So when you use the cost-based approach, the total cost of the contract is 400,000, and out of which we have incurred already 300,000 out of 400,000. And then you can calculate the percentage completion. The percentage completion is 75% for this question. So now you can recognize 75% of the revenue. 75% of the revenue will be 500 into 75. It will be 3,75,000. 75% of the profit will be 75,000, and balance sheet figure will be 3 lakhs. Wonderful. So this is how you need to recognize the revenues, the cost, and the profit based on the percentage completion method, and the approach is cost approach, which is also called input approach. Yes, the cost will be the balancing figure. In SOCI, this profit will be added in the overall profit of the business. So the sales will be added in the overall sales, the cost of sales will be added in the overall cost of sales, and definitely the profit will be included in the overall profit of the business. So 75,000 is the profit, not the contract asset. Value of the work certified to date. Value of the work certified to date means that what amount out of the total revenue you have certified. In fact, you have earned. So actually, in these type of the construction contract, they are actually government-based surveyors who visit your site, and based on the level of the construction that you have performed, they give you the certification that your contract is, say, for example, 40% complete, or you have earned 400,000 out of 500,000. So whatever be the amount, they will give you a certification for that particular level. And can we take directly 75,000 revenue? No. The 75,000 will only be adjusted when the question asks you about to do the adjustment in the retained earnings. So there are some questions in which the examiner will ask you to do the retained earning adjustment, then you can use the word the amount 75,000. Otherwise, you have to include 3,75,000 the revenue, 3 lakh in the cost of sales, and then 75,000 will be reported in the profit. What will be the contract asset or liability? Let me tell you about the balance sheet approach. Right now, we are focusing on the income statement. Now, the second approach is the work certified approach. Work certified approach, in which you need to take the amount of the work certified to date divided by total revenue. So when you divide 400,000 by 500,000, you got the percentage completion of 80%. So with reference to the work certified approach, your contract is 80% completed. So the sales revenue in this situation will be 4 lakh, cost of sales, and profit. Profits will be 80,000. The cost will be 3,20,000. So this is all about the income statement approach, and I have solved the question. Yeah, when the students want the video recording of EPS, I will share the video recording of EPS as well. Don't need to worry about it. Let's try to focus right now. Focus on this area. The cost will be the balancing figure. Now, I think it's done. But do remember this. I think have you all noted down this slide? I actually wanted to remove everything. Yeah, you can take the 80% of the total cost, but it's better to take the cost of sale as a balancing figure. Okay. Now, what about the question? If the question tells you that the total revenue of this contract is 5 lakh, the total cost of this contract is 6 lakh, and there will be a total loss of 1 lakh. So IFRS 15, according to IFRS 15, you cannot apportion the loss. Only the profit element can be apportioned, but when there is a loss, it should be charged in full. Now, what does it mean? That assuming the percentage completion is 80%, we need to take the revenue, which is 80%, 4 lakh, cost, and the total loss. So you have to take the total loss completely in the income statement in year 1. The loss should not be proportionated based on the percentage completion. So the cost will be the balancing figure. So that's why we take the cost as the balancing figure, because if I apply the percentage directly on the cost, it will not give me the right answer. So in this case, the cost should be 5 lakh because we have suffered a loss. So it's a loss making question. How do we get 375? I don't know. Where's 375? Okay, 375 is the 80% of the, no, so 75% of the revenue. Yeah, 75% of the revenue. Now moving on towards the next question that is related to the balance sheet. Whenever you go for the balance sheet, do remember this point that we always take the cumulative figure. The cost incurred to date will be the total cost that you have incurred till date, plus profits, or if there is a loss, it should be deducted, and less progress billing. If there is an amount with a positive sign, then it means it's a contract asset. And if there is a negative in value, it will be a contract liability. So the most important point is that when we prepare the balance sheet, it will be based on the values till date. Values till date means that you need to report the cumulative figures up till date. But for the income statement, we only report 12 months data. Suppose if it is the second year of the contract, then in the income statement, you need to report only the profit that you have earned in the 12 months, in the current 12 months. But when you are reporting the balance sheet, you need to report the cumulative profit of the 2 years. Gross income to date in the whole life of the contract, the profit that you have earned up till the date, and the progress that you have built to the customer should be deducted. So whatever left at the end of the period is, if it is positive, then it will be reported as a contract asset, and if it is negative value, then it will be reported as a contract liability. I want you guys to solve this question. I'm giving you just 30 seconds to attempt this question. You have 30 seconds to solve it. Is it done? So let's start the question. On 1st January 2004, NM entered into a contract with a customer to construct a specialized building for an agreed price of 30 million. Okay. At 31st December, NM incurred a total cost of 14 million. Till date, 14 million was incurred. And the estimated cost to complete the contract would amount to 7 million. So the total revenue of the contract is 30 million and the total cost of the contract is 21 million. So the total profit that you need to earn from this contract will be 9 million. Names measure the progress towards the contract completion using the input method. Input method means based on the cost. So you need to calculate the profits. So these percentage will be cost incurred to date divided by total cost. So the percentage will be 60%, 67%. So as you have earned 67% of the profit as well, so you need to take the 67% of the 9 million. So when you multiply 9 million by 67%, you got the value of 6.03. The 6.03 is the amount of the profit that you have earned till date, and 12 million from the customer, that is the progress billing that you have charged to the customer. So your net answer should be 8.03. That is your contract asset. If the work certified method, the amount of the work certified is not given, then the progress billing is work certified. Yes. Progress billing and work certified will be assumed to be equal in the case when you have not been given the work certified today. They have used the word cumulative. Kindly explain. Cumulative means that you need to report the total amount for all the years. Suppose if it is a third year of the contract, so when you prepare the income statement, it only shows you the amount of the revenue, cost, and profit that you have earned in this particular period. So in the third year, when you prepare the income statement, sales will be reported for the 12 months, cost will be reported for the 12 months, and profit will be reported for the 12 months. But when you prepare the balance sheet at the end of the third year, you need to report the total cost till date, total profit till date, and the total progress billing. Because we prepare the balance sheet with the title as at or as on. As at or as on means that you are going to report the value of the asset or liability till the year end. But when we prepare the income statement, the heading will be the the name of the company, then the statement of profit and loss for the year ended on. For the year ended on means that you are going to reflect the financial result for the coming 12 months only, for the current 12 months. So it will not going to tell you about the past and or the future. When you are going to report in the balance sheet, it should be the cumulative figures. Cumulative means by adding all the previous year's value. 21 come from? Where is this 21? 21 is the total cost. 14 million you have incurred plus 7 million that you need to incur in the future. No. Every accounting standard follows the double entry system. So it has their own entries, but which are not usually examinable. That's why we are not going to waste time. But every accounting aspect will be based on a double entry system. If the customer will pay you 22 million, then that means there will be a contract liability. 14 plus 6 minus 22. So there will be a contract liability of 2 million. If you calculate 12 million divided by into 67%, that's wrong. That's actually you are getting the answers by chance. So please solve this one. Is it done? Now let's solve this one. Dugan entered into the contract where the performance obligation is satisfied over time. The total price of the contract is 9 million. Now, first you need to write the total price of the contract, which is 9 million. The total expected cost of 5 million. So the total cost will be 5 million. So here we have got the total profit of 4 million. The progress towards the completion was measured at 50%. So they have already calculated and given us the percentage of 50% for the first year and 80% for the second year. The correct entries were made as so you are required to calculate the figures for June 8. So this contract is 50% completed in the first year and 80% completed in the second year. Now, the figures of the percentage will always be, again, remember this point will always be a cumulative figure. So what does it mean? That this contract is 80% completed at the end of year 2. But we have already done 50% of the work in the first year. So in the second year, there will be additional 30% of the work that we need to do. So for the first year, the revenues will be 4,500, the cost will be 2,500, the profit will be 2,000. For the second year, the profits will be, revenue will be 2,700, the cost will be 1,500, or the profit will be 1,200. I hope it's clear now. In the current year's income statement, you need to add 2,700 in the revenue, 1,500 in the cost of sales, and the profit will be automatically be included in the Can you please show the question? Yes, I can. This is Dugat note number 1. Now, this question does not provide us the enough data to prepare the balance sheet. That's why we will not find the requirement even in the requirement. There is no need to report the balance sheet because the data is not enough. Now we have already done this part of the question. Now attempt this part, please. Haverford. %80 of the where is the figures for 2007 and these are the figures for 2008. The balance sheet you need to report second year's data. No. So if the same scenario, you will provide with the full marks. Yeah, you will get the 100% marks if you are solving it correctly. 2,700 how? What I told you previously that this this contract is 80% completed in the second year in total and 50% completed in the first year. So that means in the second year only, it has only done the work of 30%. So when you take 30% figures of the total revenue, total profit, you will get these figures. In the first year, we have earned these figures, and the second year, we have earned these figures. Okay, let's do note number 2 of Haverford. Note number 2 of Haverford. Haverford note 2. Yes, is it done? Do you guys want me to solve this question or it's fine? Should I solve it? Solve. Okay. During the year, Haverford entered a contract to construct an asset for a customer satisfying the performance obligation over time. The contract had a total price of 14 million. Now, the total price of the contract is 14 million. So first you need to write down the total price. The cost to date is 1.9 million are included in the above balance. Cost to complete are estimated at 7.1 million. So in total, when we add these two figures of the cost, we get the value of 9 million. So it is actually 9,000 that you need to incur in order to complete the contract. So in this contract, the profit figure is 5,000. At 31st December 2007, the contract is estimated to be 40% complete. And to date, Haverford company has received 1.4 million the customer. So this contract is 40% completed. So you can book the revenues 40%. So in the income statement, 14,000 into 40%. The amount will be 5,600 for the revenue, 3,600 for the cost, and the profit will be 2,000. The 2,000 is the amount which will go in the income statement. Now, as it has a sufficient data, then we can prepare the balance sheet as well. The cost incurred to date is 1.9 million. The profit that we have earned till date is 2,000. And the progress billing will be 1.4 million, 1,400. So by adding these figures, 1,900 plus 2,000 minus 1,400. The amount will be 2,500. Very good. It will be a contract asset of 2,500. So in the contract cost, we add depreciation of the plant and the machinery, but why we did add depreciation charge in both the cost to date, the cost to complete? Why we didn't add it once, only the cost to date? Okay. Okay, with reference to Madhya Firdaus, I'm giving you the answer for you. When we calculate the total cost, we included the total cost of the non-current asset like plant or machinery in order to calculate the total cost of the contract. But in the question, when you have been given the cost incurred to date that you reported on the balance sheet, it does not include the cost of the asset. So therefore, you need to add depreciation separately, which is the cost of the asset. So that's why we do it like this. I hope I've cleared it out. Tell me about the consignment. Okay. Contract asset is 2,500. Is it clear? I think it's clear now. Now we have covered this slide as well, finally. Now the sale or return basis. This is one of the arrangement in which you sell the goods based on the terms that at the future date there might be a sale or there might be a return of the goods, depending on your customer. Like if you sell the goods to B on the agreement of sale or return, then B will inform A whether he is accepting the goods or whether he is going to return the goods. So suppose on 1st January, you have delivered the goods to B. And you have given 1 month to B till 31st December to inform you that whether they are going to accept, whether B is going to accept the goods or whether we want to return the goods. So my question is, should we record the sales on 1st January or not? So there should be no accounting entry at this point of time, which is 1st January, because you have no idea about this transaction, that whether B is going to accept these goods or we will return the goods. So it will be confirmed on 31st December. So if B will accept the goods, the accounting entry will be debtors debit and sales credit. And if the B returns the good, then there will be no entry because we haven't made any accounting entry yet. Now, these are the tools of the window dressing. These are the tools of the window dressing that usually what people do, that near the year end, they deliver the goods on sale or return basis. So when they deliver the goods on sale or return basis, they usually record this transaction by debiting the debtors and crediting sales in order to boost their sales at the year end. But what accounting says that if the arrangement is sale or return, then you can only recognize the sales when the customer will confirm you. So if the customer didn't confirm you till the year end and you have made this accounting entry, then you need to reverse this entry. So the accounting treatment for this case will be, you need to reverse this transaction. Number one, and the cost should be included in the closing stock, because you are saying that we have not yet sold this stock. Closing stock will be adjusted for the cost of sale and return goods. But the goods has been transferred. Initially is saying that the goods have been transferred. Goods have been transferred to the customer, but we didn't transfer the risk and rewards of the ownership. So there will be no accounting entry on 1st January when you could transfer the goods to someone or the customer on sale or return basis. You can only make the accounting entry when the customer will confirm that he is going to accept the goods. If the goods get damaged before 31st January, then this will be the loss of the supplier. If the customer confirms after the year end, if the customer confirms after the year end, then it will be considered in the next year. It's the same concept like the goods in transit. No, this is quite different to the goods in transit. Closing stock approach again. Actually, we haven't sold the goods up till date. We have just transferred the physical position of the goods. So that's why we need to report these stock, because we are not recording the sales. So we need to report this stock in the closing stock. Yeah, the sales before the year end and the date is confirmed after the year end, then there will be an application of IS 10, that the confirmation will be made after the year end, but before the preparation of the financial statement, that it will be an adjusting event for the company. It will be recognized at the cost. And in fact, if the NRV is lower, then it will be at the NRV. Easy solve the numerical but the confusion while making the adjustment in the balance sheet and income statement. Any help in this issue? Dhananjali, I just wanted to say about this. Your case is you need to do the practice on the constructive response workspace. So if you solve 3 to 4 questions on the constructive response workspace, then just your problem will be resolved. If the customer confirms after the year end, but would not be an adjusting event after the reporting period, then it will be reported next year. The sales will be reported in the next year. So I want all you guys to attempt this part of the question. Sale or return adjustment. Sales revenue includes 50 million, which the company has made on the sale or return basis with a gross profit margin of 40%. The customer has not yet confirmed that he will pay for the goods or not. So the customer has not yet confirmed about the goods. So you have to you have to reverse this transaction because you have already recognized the revenue. So for the first step will be you need to reverse this transaction of the revenue. And the second treatment will be you need to identify the cost of this stock and include it in the closing stock. Please solve this question. So the first treatment should be revenue debit 50 and receivables credit 50. So whatever revenue that we have recognized for sale or return basis should be reversed. And then you need to include in the closing stock the cost of this stock. So if the gross profit margin is 40%, so the cost can be calculated by dividing this by 100 and multiplying it with the 60. Thus the cost price will be 30. So 30 should be added in the, no, it's not sales return. In Shal Khan, it's not sales return. If you treat like a sales return, then it will be considered as that you have made the sales and subsequently the customer has returned the goods. But in fact, this transaction has not taken place. There is no sales till date. So how can you record the sales return? Will we decrease the cost of sales with the 30 million? It depends. It depends if the company has charged the 30 million in the cost of sales, then you need to adjust the cost of sales as well. Now the next figure is sale or return repurchase agreement. In these situations, this is one of the situation of window dressing. In this situation, company sold goods to someone and agrees to buy back on the future date from Mr. B. So this is again a window dressing. So what the company normally do, the company normally does its sales at the year end in order to boost the sales and the profitability on sale and repurchase agreements. And after the year end, when the audit report was done, when the annual general meeting was done, the shareholders were satisfied, company silently buy back all the closing inventory. And the terms will be Like if the company has sold the goods for 6 lakh, it will buy back at a value which should be more than 6 lakh. So this party will get the benefit of this 50,000 extra just to hold the inventory for a few times. So this is one of the arrangement of window dressing. Mr. A at the time of selling this goods recognizes transaction as the cash debit 600,000 and sales credit. So there will be two positive impact for this transaction. One is the liquidity has improved substantially. The second is the sale has grown. If the sales grow, the profit will go up, the shareholders will be happy. But accounting says that this is a window dressing. This is a fake sale. This is an artificial sale. So the correct treatment for this 6 lakh should be cash debit 6 lakh, and it should be a substance loan. Because you need to return this loan on the future date with interest. So sale and repurchase transaction is in fact not a sale, it is a loan arrangement. So if the company has recognized the sales, so all you need to do is to reverse the sale transaction and recognize the loan instead of sales. And definitely when there is a loan, there will be a finance cost or interest cost for this loan. So let's solve this this part of the question. Please read the question very carefully. This is a concept of substance over legal form. Now, Xavier sells its head office at a cost of 10 million to Zurich, a bank, for 10 million. So the accounting entry should be cash debit in a normal scenario and head office assets credit by 10 million. A bank for 10 million. On 1st January 2002, the Xavier has the option to repurchase the property at 31st December 2005, 4 years later at 12 million. Xavier will continue to use the property as normal throughout the period and so is responsible for its maintenance and insurance. The head office was valued at transfer on 1st January 2002 at 18 million and is expected to rise in the value over the 4 years. Give the reason how Xavier should record the above during the first year following the transfer. So what you need to do is to record the transaction and transfer it into the loan. So the adjustment should be asset will be capitalized again by 10 million and loan will be recorded at 10 million. And from this date, you need to book the finance cost, for which the percentage is not given, so you can use the straight line method. So you need to pay extra 2 million in 4 years. So the finance cost for the first year will be 0.5 million. So the finance cost will be 0.5 million. So if the company has made a sales and sell it on the sale and repurchase agreement, then this should be recognized as a loan. So simple treatment is record the loan in place of sales, and the second treatment is closing stock should be added with the cost of the sale or return. So this will be the treatment for the inventory, but in this adjustment we have been given a non-current asset, so we do the adjustment for the non-current asset. What happens when the cost is not the same as the selling price? So whatever amount that you receive in base of the substance or form, it will be recognized as a loan. Because we are selling this at a value of 10 and we will buy back at the value of 12. So there will be 2 additional amount that you need to pay over the 4 years. So that's why I have used this word, and the 4 years was given here. So 2 million divided by 4 will be the finance cost for the each year. Commission sales. $18 million. You do not need to be to adjust the 80 million right now. Why we add the cost to the closing inventory? Because again, we are saying that if the inventory was not yet sold, then it should be reported in the closing inventory. So if it would be have been the current asset, then how much would have been the cost be? The cost will be the 10 million for this case. If in this question there will be 10 million, so it should be the 10 million. If the selling price was 1100, Ilvia de Souza is keen to know that what will be the accounting entry. The accounting entry will be 1100. I'm just telling you for you, telling this for you, Olivia. The asset will be reported at 10,000 and they will recognize definitely a gain of 1,000. What they will do if they sold this for 11,000. But from the substance of form point of view and IFRS 11, the accounting entry should be cash debit and loan credit. So the adjusting entry should be asset debit 10,000, gain should be reversed by 1,000 and loan will be credited by 11,000. And then based on this loan, you need to book the finance cost. That's all. Now, I hope I have cleared the points. The next thing is related to commission sales. It's all about the commission. Like when you work as an agent for your principal company, then you can only book the commission, not the gross sales. Suppose if someone allows you to do sales of $100,000 and you will get a commission of 10%. So your portion from this 100,000 will be 10,000. So in your income statement, you can only book this revenue or income rather than this amount. This is called window dressing. So what the companies who are working as an agent do, they record the sales of the principal company actually. So what you need to do is to reverse the amount of the principal, and you can only recognize the amount of the sales of your part. So you can only recognize your part of the revenue rather than your principal company. So please try to attempt this one. Rosemary Company's revenue includes 2 million. Please make the relevant accounting entries for this. Okay, so let's start the point. Rosemary Company includes revenue of 2 million. So they have recognized a revenue of 2 million for the goods. It's sold acting as an agent for Elaine. So you are actually the agent company in which you will be entitled only to record a commission of 20%. So if you made a sale of $2 million, your part of the commission is 20%. So it will be 400. So you can only recognize 400 as your income or revenue. But what the company has done, they have done the window dressing by recognizing the revenues of 2 million. And of these sales and the remitted difference of 1.6 million, including the cost of sales to Elaine. So what they do, they first record the transaction by debiting the cash 2 million and crediting the sales by 2 million, and then charge the cost of goods sold of 1600, and cash is 1600. So is this the reality? What message you are giving to the shareholders? You are saying that we are buying the inventory for 1600 and selling it for at a value of 400, 2000, and 400 is our profit. So are you actually buying the inventory and selling it to the third party and earning a profit of 400? This is not true. This is false. So the actual reality is you are working as an agent on the behalf of the principal company. You made the sales and you can only recognize 400 out of this. That's your accounting entry should be. But what the company is reflecting in front of the shareholders, that we are buying inventory for 1600 and selling it for 2000 and earning a profit of 400. which is not true. This is totally false statement. So what adjustment is required? What adjustment is required in the income statement? So first entry should be, the adjusting entry should be for this situation. Sales should be debited by 1600 and cost of goods sold should be credited by 1600. So that should be the case. So the adjusting entry will be sales debit and cost of goods sold credit for this question. I hope it's clear now. Is it clear? Why sales debiting? Because we have to reduce the sales figure from 2000 to 400. So that's why we are reducing 1600 from the sales. Yeah, the company who is doing its business on the as a commission, on commission basis, then this will be the revenue for that type of companies who are working as an agent. 1.6 million is not a non-current liability because you have already paid it. No, we will not adjust the cash because you have already paid the whole amount of the cash. So the cash is done. Now, we're going to start the new topics, that is financial instruments. Financial instruments. Excused. Shirali, you wanted to ask about something? Should I start this topic? Or do you think it's easy? Just clear that where we should add the depreciation of the asset. Use specific contract number. Shiraj, I actually it's too late right now. I'm going to start the new standard. So if it is possible for you to please do ask this question on the WhatsApp directly to me, I will respond to you. Because if I involve again with this topic, so the people will be confused. So let's start the topic with this financial instruments. Financial instruments means the contract that give rise to the financial asset of one entity and financial liability or equity instrument of another. So financial instruments are actually contracts which gives rise to financial assets of one entity and financial liability or equity instrument of another entity. So what are assets? You already knew about the assets. Assets could be non-current assets and assets could be current assets. But there are certain type of assets out of this total asset is called financial assets. So what are actually financial assets? So this standard is all about financial assets, financial liabilities, and equity instruments. So the name of this standard is IFRS 9 and IS 32. So we are covering two standards at the same time right now in this topic. So financial assets includes the cash. An equity instrument of other entity means the shares of any company. The contractual right to receive cash on another financial asset. The contractual right to receive cash means debtors on loan assets. Or any other commitments or any other contracts for which you need to receive the cash. A contract contractual right to exchange a financial asset, financial liability, which are potentially favorable. So if the contract is favorable for you, then it will be a financial asset. So these are the definitions of financial assets. Examiner might ask you, yeah, lease is also a financial instrument, but the accounting treatment of the lease is separate and it will be governed under IFRS 16. Okay. Now, financial liability, the contractual obligation. The very important thing is the contractual obligation to deliver cash or under financial. So if your liability is because of some legal contract, then it will be your financial liability. Suppose, for example, the tax liability is not a financial liability because you need to pay the tax, but there is no contract between you and the government that you need to pay the tax. It is actually an imposed liability from the government that you have to pay the tax to the government if you are earning a profit. So liability should be contractual. And any type of contractual arrangement which is unfavorable for the company. So these are the definitions of financial assets and financial liabilities. Is it clear to all of you? So if it is clear, can you give me an example of this one? What type of financial liability will be covered under this definition? If it is clear to you guys. This will include all types of loans, account payables. But what type of liability will be covered in this category? No. Fines, penalty, shares transfers, debt administration. No, 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 no. Share exchange. That's no way. Debentures. Yeah, debentures, loan notes, and account payables, or in the redeemable preference shares, they all will be considered, but for the first definition. But what about the second one? Can you give the example of this part? No, 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 no. No, no. I think without wasting your time, I should give the example for this case. Now read this point. The contractual right to exchange a financial asset, financial liability on favorable terms. So if the contractual obligation is favorable, then it will be a financial asset, and if it is unfavorable, it will be a financial asset. So actually, the main concept behind this is derivatives. So this is related to derivatives. So those students who have studied F9, they knew about the derivatives concept, but right now I'm giving you just a simple example for the derivative so that you can understand. Debentures can be the example of financial liability, but with reference to the first definition. Right now I'm talking about the second definition of financial asset, financial liability, and the fourth definition of financial asset. Now, suppose, I don't know about your country, but in our country, the rate of £1 is equals to approximately 220 rupees. And we all knew that we need to pay the annual subscription fees and we need to pay the examination fees. So suppose we knew that we in the future we need to buy £1,000. So what will be the cost of £1,000? £1,000 will be cost 220. So it will be 2,20,000 in Pakistani rupees. So in Pak rupees, £1,000 is equals to 2,20,000 rupees. So I'm facing the risk that the pound, if the rate of the pound will increase in the future, it will be a loss for me. So what I do, I do commitment, I do a contract with a party B, and we lock the value of this pound at a value of 225. So I am giving you the assurance that I will buy £1,000 from you at a price of 225. And B has to sell me £1,000 at a price of 225. This is the contract that we made right now. These are called, technically these are called forward contracts. Now, in the open market, if the value of the pound is 220, so will this contract will be favorable for A or B? What do you think? Whether this contract will be favorable for A or for B? Yeah, this contract will be favorable for B. How this will be favorable? Because B will buy the pound from the open market at a value of 220 and he will sell it to me at a price of 225. And we, Mr. A, despite of this fact that open market can provide you the pound at a value of 220, I have to buy based because of the contract at a value of 225 at an expensive price. So now this contract is right now in this situation is a financial asset for Mr. B and it is a financial liability for Mr. A. But what if the value of the pound will go up to 250 in the open market? So will it be favorable for A or B? So if the open market, the prices will go up by 250, this will be a blessing for Mr. A and a nightmare for B, that we have to buy pounds at a value of 250 and he has to sell me at a value of 225. And A will get the benefit because the open market will give the pounds at a value of 250 to A, but because of this contract, it will be cost Mr. A just 225 for each pound. So now in this case, this contract is now the financial asset for one party and financial asset liability for the other party. I think I have cleared this point. It's related to the forex. Is it clear? Derivatives are not examinable, but you only need to know about little concept about this derivative. So if there is something missing with reference to understandability for anyone, that you can review my recorded lecture, and you'll be having the option to repeat that lecture as many times as you want. But right now, I don't have enough time to repeat the concept again and again. So apologies for this point that I cannot repeat the point many times. Okay. Now, what about the financial liabilities? All financial liabilities should be measured at amortized cost. Amortized cost means you need to make the amortization table like we have done already in leases. Like it should be measured at obligation at start plus interest minus payments is equals to obligation at end. This is called amortized cost. Liability versus equity. If the instrument has an option of repayment, then it will be a liability. But if the instrument has the option of the repayment only in case of the liquidation of the company, then it will be an equity. So that is the reason we call redeemable preference shares as a liability and irredeemable preference shares as equity. So irredeemable preference shares and ordinary shares, they both are equity in nature because you do not need to pay anything, any amount. But the redeemable portion, if the preference shares are redeemable, that means that you need to repay the amount at a particular specific date, then it should be considered as a liability. But talking about the financial assets, if it is equity instruments, it could be measured at fair value through P&L or fair value through OCI. We have two categories for financial assets. Fair value through P&L and fair value through OCI. So this is the default category for equity instruments, that all type of equity instruments should be classified under fair value through P&L category. But if you wanted to hold your investment for the longer and longer term, then you can exercise this option and place the equity instrument at fair value through P&L. But if your intention is held for trading, then it should be classified in P&L. But if your intention is to hold the shares for a longer and longer term, then it could be placed at fair value through OCI. Now, in the fair value through P&L category, all gains and losses will be reported in P&L. And in the fair value through OCI category, all gains and losses will be reported in the OCI. But you need to consider this point that the transaction cost should be added in this case. So if there is any transaction cost related to the purchase of the shares, then it should be capitalized. And this option is irrevocable. Irrevocable option means that if you exercise this option, then you cannot transfer your financial asset into fair value through P&L category in the future. But if you have measured under this category fair value through P&L, you can transfer your instrument into this category. So moving from fair value through P&L, fair value through P&L to OCI is allowed, but fair value through OCI to P&L is not allowed under standard. Is it clear? Wait. Right now we are talking about the financial asset. Is the financial asset is clear to you guys with reference to the equity instrument? If the answer is yes, then I want you to just read this part of the question and reply your answers. Heading for this handout should be IFRS 9 and 32. Okay, please read this part of the question. And give your answers. Will the transfer from the fair value to P&L to fair value to OCI was a change in accounting policy? No. Now, investment one, 10% of the issued share capital of Haruka company, the shareholding was acquired as long-term investment. Long-term investment. So what you need to do, it should be measured at fair value through P&L or OCI. It should be measured at fair value through OCI. Very good. But in the second scenario, issued the share capital of the Lucas company, this shareholding was acquired for a speculative purpose. Speculative means that your intention is to buy and sell the shares in short term, in short run. This is called held for trading intention. Your intention is held for trading. So if your intention is held for trading, then this category should be, the category for this should be fair value through P&L. P&L. Is it clear to all of you? Okay, what does the last line means? Neither the shareholding gives the tenant a significant influence over the investing. Significant influence, because if there is a significant influence, then it should be the part of IS 28. Then it should be covered under IS 28. And where possible, the director of Senate wishes to avoid taking any fair value movements to P&L, so as to minimize the volatility in the reported earnings. So this part of the question says to you that director is unwilling to report the fair value changes in P&L. So that's why for the first category, they can go for fair value through OCI. But for the second part, standards specifically mention that if you have got the equity instrument which is held for trading, then it should be placed at fair value through P&L. So that's why second part will go in fair value through P&L. Yeah, relates to within the 12 months, right? Yes, within 12 months. Okay, going towards again. Now, what about the financial liability? Financial liability has a default position of amortized cost. So all types of financial liability should be measured at amortized cost. But if the financial liability is held for trading, then this type of liability can only be classified in fair value through P&L. Otherwise, all types of financial liabilities will be reported in at amortized cost. What will happen if it is accounted for in IS 28? Said Fazil, it will be applied according to IS 28. I'm not teaching right now IS 28. But for your guidance, I can tell you that this will be accounted for under equity method. So please don't ask what is equity method, because we will cover this concept in IS consolidation topic. Now, what about the financial asset if it is debt instrument? Debt instrument means a loan asset. If we have got a loan asset, then what will be the treatment? So we will be having three treatments. The first one is fair value through P&L. Then we have fair value through OCI and fair value through, and the third one is the amortized cost. So do remember this point, that examiner can confuse you in the loan instrument. Like if the company is issuing the loan instrument, and if the company is acquiring the loan instruments, then which one is the financial asset and which one is the financial liability? Give an example of held for trading. Held for trading means any type of instrument that we acquire for the short term period, and the intention is immediately buying and selling. So the example of is the derivative liability. So I have already given you the example of the derivatives. The derivative liabilities are actually held for trading liabilities. Yes, that's a very important part. If the company is issuing the debentures or loan notes, then it will be a financial liability, because company is issuing the instruments and borrowing the funds. But if the company is acquiring, means the company is purchasing the bonds and paying it against the bond, then this will be the investment financial asset. So this is a very important point. Financial liabilities, for financial liabilities, we have only two categories: fair value through P&L and amortized cost. But for the financial assets, we have got three categories: fair value through P&L, fair value through OCI, and amortized cost. Now here in the amortized cost, you need to deduct the issue cost and the discounts. If there is some discounts on the issue cost in the instrument, then it should be deducted when you're measuring the financial assets. Sorry. You need to add the issue cost in financial assets. And for financial liability, you need to deduct That is the PV means it's not the present value, it's the par value of the instrument, less issue cost, less discount. And in the amortization area, the issue cost should be capitalized. Now, in order to classify a financial asset into amortized cost method, it needs to pass two tests: business model test, and the second test is the cash flow test. Now, the question is when the business model test will pass. If the intention is to hold the instrument till maturity. If my intention is to hold this debenture instruments till maturity, then business model test is passed. And cash flow test will be passed when the cash flows of this instrument will be based on, and the cash flows of this instrument should be based on principal plus interest. If both the tests are passed, then it should be measured at amortized cost. And the issue cost, do remember this point, the issue cost must be capitalized. But in the OCI category, we have again two tests: business model test and cash flow test. The cash flow test is similar to the cash flow test of the amortized cost, but the business model test says that if your intention is to hold for some period and then sell that investment, then it can be placed into fair value through OCI category. But if no test pass, if no criteria for the amortized cost and the fair value through OCI was met, then it can be classified at fair value through P&L. This is a default category. So you can place any type of debenture assets into fair value through P&L category. And do remember this point, that in this category, if the instrument is held for trading, then it should be classified into P&L. Here, the gains and losses will go in the OCI, but the transaction cost should be capitalized. Transaction cost should be capitalized in both the amortization cost and fair value through OCI category. Now, you can ask anything about this topic. Amortized cost means that you need to amortize the value of the asset or a liability by charging the interest. It does not mean the present value. Par value is the original value of the instrument that we have got, that's similar to the concept of that we have in shares. That has a fixed value, which is the par value, and the market value is the current value. Cash flow test means the cash flows of that instrument should be based on the principal amount and the interest amount. Okay. So if this is clear, I want all of you guys to do this question. First attempt this question. No, don't think about the break. Right now we are please solve this question. You only have 2 minutes for this. 1 minute, in fact, 1 minute. So let's start the point. The company issues means it's a loan. So the table will be obligation at start plus interest minus payment is equals to obligation at end. The original par value of the instrument is 20,000. The discount is 2.5%. So the 2.5% discount will be 500, I think. Yes. 500 minus issue cost will be 534. So this will be the obligation at start. So 18966 is with my obligation at start. 8966. Now the interest should be based on the effective rate. So 18966 into 7% will be 1328. The interest will be 1328. But do remember this point that payment will always be made at the par value. Par value of the instrument is 20,000 into 4% the nominal rate. That will be 800. The obligation at end should be 19494. 19494. That's the point. So this amount should be reported in non-current liability. This amount will go in the finance cost. Is it clear? Yes, wonderful. So let's attempt this part of the question. That is, yes, please do attempt this part. No, you do not need to work on the current and non-current liability for the financial instruments. The concept of current liability and non-current liability will only occur in leases and IS-20 government grants. 10% is the amount of the premium. So always remember this point that we always book the finance cost on the effective rate. No, we never record the liability at the present value. Please solve this part. So let's start solving this part of the question. When non acquired 9 million 5% bond at a par value of 1 January. So if the question clearly states that we have acquired the bonds, then it means it's a financial asset. So the table will be financial asset at start plus interest income minus receipt is equals to financial asset at end. So this should be the format of the table. Receipt should be deducted from here. Okay. Now the bond is having a value of 9 million, 5% at the par value. The interest is receivable on 31st December each year. The when non incurred 0.4 million broker fee. So this will be the issue cost of acquiring the bond. So the obligation at start should be 9,400 by capitalizing the finance cost. Then we need to see the effective rate of the interest. Effective rate is 8%. So 8% amount will be 752. But you need to see whenever you are calculating the interest, always remember this point that interest will be based on the time period. So if the time period is 12 months already, then you can book the whole year's interest. Otherwise, it should be proportionated. The payment will be 9,000 into 5%, which will be 450. So the obligation at end should be 9702. So this will be our financial asset. This will be my finance income. This is not a finance cost. Now this is a finance income of the business. I hope it's clear. No, it's an amortized cost method. You don't need to use payable through OCR. Is it clear? Financial assets at your level should be measured at the amortized cost, because the calculation of the financial assets measured at the fair value through P&L with reference to the debt instrument. At fair value through P&L or OCI is usually asked by the examiner in SBR. So at your level, whenever the examiner asks about the financial assets, it should be measured at the amortized cost if the instrument is debt instrument. But equity can be in favor of the P&L or OCI. Yes, in amortized cost method, transaction cost should be capitalized if you are dealing with the assets. But if the case is the financial liability, then it should be deducted from the par value. So the people are tired, I think. So let's take a break of 5 minutes. We should add the initial cost on the financial assets. Yes, financial assets. Initially, you need to capitalize the initial cost, and then some subsequent measurement you need to take the value which is reported at the closing. So the next topic we will be discussing is convertible loan. But before starting this point, we will take a break of 5 minutes. It's a tea break, or you can take it as a water break. Please do not go anywhere. I'm just coming in 5 minutes. Okay, you welcome back after the break. So let's start the session again. Yeah, it's a very long 5 minutes. Actually, I was just eating something, so it will take some time. Okay, so let's start the session again. The, the name of the topic is convertible loan. Convertible loan means a loan which can be converted into ordinary shares. So convertible loan means a simple loan and it has got the conversion option. So when we attach the option into the loan, it will become a convertible loan. So that option has got the potential to convert Can you hear my voice clearly? But the student saying, one of the students is saying that he didn't hear the voice. Please confirm me whether my voice is clear, loud and clear. Okay. Thank you for the feedback. Okay. So convertible loans mean the loans in which you have attached a conversion option, and based on this option, using this option, you can convert that loan into ordinary share. So actually, when you add into a simple loan the equity option, it will become a convertible loan. It will become a convertible loan. And according to IS 32, this portion is a liability, but this portion is actually an equity. So first you need to do is to break the value of the convertible loan into equity and liability. And the equity option should be shown separately on the balance sheet in the equity section, and the liability section, and the amount of the loan will be reported in the liability section, and this loan will be amortized for future report. So that's the whole concept of this convertible loan. It's one of the favorite area of the examiner. Now the question is, on 1st January 2005, 5% convertible loan notes is issued for 5,000. The loan is repayable after 3 years for the cash of 5,000 or may be converted into shares. The market rate of the loan notes without conversion option is 8%. So the rate of the simple loan is 8%. Now the first requirement is to split the loan at the inception between the equity and liability. So how we break the liability and equity from the convertible loan? So what we do, we have been given a value of convertible loan, and then we calculate the present value of the future cash flows for the liability. So when you calculate the present value of the future cash flows of the liability, this will be my liability component, and the residual balancing figure will be the equity component. So what you need to do is to calculate the cash flows of the loan. So this is a 3 years loan. So first I'm going to calculate the cash flows. Now the loan is having a value of 5,000 and it carries an interest of 5%. So the cash flow for the first year will be 250. Cash flow for the second year will be 250. That's the interest of the loan. And cash flow for the third year will be 5250. So these are the cash flows of this instrument assuming that this is not going to be converted in the future. Now, taking a discount factor of 8%. Do remember this, that whenever we are going to take the discount rate, we always use the discount rates of the loan without conversion option. So here we have been given a discount factor of 0.93, 0.86, and 0.79. So by multiplying these amounts, you get the value of liability. So 250 into 0.93 plus 250 into 0.86 plus 5250 into 0.79. So the amount of the liability will be in total 4595. So 45. The total value of the instrument is 5,000, and 4595 is the value of the liability. So the balancing figure will be the equity option. So the balancing figure should be 405. So is it clear to all of you? Okay. Can we take the annuity directly, because the cash flows are not the same for all the years? Therefore, you cannot use the annuity, because annuity will be used only when the cash flows are constant over the period. So what should be the accounting entry for this? What should be the accounting entry for this transaction? The accounting entry should be cash debit by 5,000, equity credit and liability credit. Equity will be credited by 4595 and liability will be credited by 405. So this amount will be reported in the equity section of the balance sheet. And this, sorry. So this is my liability. This is my liability and this is equity option. So this equity option will be reported in the equity on the face of the balance sheet with the name equity option, like share capital, share premium, and equity options. And this will be the liability which should be amortized in the future. So how you need to do amortization? Very simple. Obligation at start is 4595. Interest will be charged now at 8%. The 8% of 4595 will be 4595 into 8%. It will be 366.68. Payment will be made at the nominal amount, which will be 250, and the obligation at end will be 4595 plus 368 minus 250. So at the face of the balance sheet, liability should be reported at 4713. So this is my non-current liability, and this will be my finance cost. So I think I have cleared this point. Under which head the equity will be reported. Now let me show you the Now this is the presentation for the balance sheet. Now this is the equity section of the balance sheet. So yes, this is the equity section of the balance sheet. So this equity option will be reported here. With the amount of 405. And the liabilities option will be convertible loan will be reported here. This is my non-current liability. I think it's 4713, the revised amount. Will you start consolidation today? No. Consolidation will be started in the next class. We will start the consolidation in the next class. So moving towards the next point. This is what we have done already. Now here is a question for you guys. Please do attempt this part. Yeah, don't worry about IS 37. We will cover IS 37. Inshallah, I'm trying to do this IS 37 today. But time is very limited. If I will not be able to cover the whole accounting standards today, so then I will cover some of the part in the next class, or I will share the recorded lectures of that portion. So the question is available for you guys. Please give your answers. Yes, the right answer is A. Because when we do the fee valuation measurement, we never consider this selling cost. So yes, the right answer is A. So actually, at the time of the purchase, this shares was valued initially at 9,000 to 6.4 plus 9,000. The value was 66,600 at the initial point. But now this shares has got the value of 7,000 into 7.25. The value will be 65,250. So there will be a loss which will go in the OCI, and that amount will be the difference between 66,600 minus 65,250. It will be 1350, which will go in the OCI. And on the face of the balance sheet, these shares will be reported at. I hope I have cleared this point. So in the transaction cost, we added in as it's yeah, we don't add the transaction cost in previous speed. Yeah, the transaction cost should be added, but at the initial point, of time. But subsequently, you only need to report the shares at its fair value. So transaction cost should be capitalized initially in favor to OCA category, and transaction cost should be charged as an expense in favor to P&L. What this question conclude us? This question is all about how these shares will be reported at the balance sheet date. So the amount at which the shares will be reported will be tranche A. We will never consider the selling cost for the shares actually. It's just given to you to make you confused. The next topic is about that doesn't mention here whether it's initial or subsequent mention. It's mentioned here. Now check the dates. Initially, we have acquired the shares on 1st October. That's the initial measurement. And they were asking about the impact on the financial statement at 31st December. So they were asking about the subsequent measurement. So if they ask you to how these shares will be recorded initially at 1st August, so the answer should be 66,600. So that's the initial point of time. But it's clearly mentioning that you need to report the value on the face of the balance sheet at 31st December. That means it's talking about the subsequent. If it is payable then through P&L, if the case is payable through P&L, then initially it will be recognized at 9,000 into 6.4, and then subsequently at 9,000 into 7.25. If the case is related to payable through P&L, then initially it should be charged as an expense. This transaction cost will be charged as an expense. Now moving towards the next point. This part is again related to the factoring under the scope of financial instruments. Factoring has two areas. The first one is with recourse and without recourse. Factoring means that you are selling your debtors to some parties and they will recover the amount on your behalf, and you will pay the commission to those parties. So there is a risk of bad debt. That who will going to bear the risk of bad debt? So if the situation is without recourse, then it means that the risk and rewards and therefore the control transfer to the factoring. So the risk and rewards of non-payment will be transferred towards the factoring company. And if the case is with recourse means the company will bear the risk of the bad debt. So when you receive the payment from the debtors, you should knew this, that the accounting entry should be cash debit and debtors credit. So that's the normal accounting treatment when you receive the cash from the debtors. But in case of the factoring, if the case is with recourse, then you can record this transaction by debiting the cash and crediting the debtors. And if this course situation is with recourse, then accounting entry should be cash debit and loan credit. That's the basic difference between the treatment. How do you differentiate between the with recourse and without recourse? It will be given in the question that who is going to bear the risk of the bad debt. So the question will tell you that the company is going to bear the risk of the bad debts. That means it's a with recourse arrangement in which you need to record whatever amount you have received in the loan account. And if the question tells you that the risk of the bad debt will be bear by the factoring company, then the accounting entry will be cash debit and debtors. So the basic concept is that do we need to de-recognize the debtors or not? So we de-recognize the debtors only in this situation when the risk is transferred to the factoring company. But you cannot de-recognize the debtors from the books because the risk of the bad debt is still at your end. So therefore, whatever amount that you receive will be recognized in the loan account. I hope I have cleared this point. For repetition, you need to see the video. It's very clear. If the risk of the bad debt will be beared by the factory company, then the accounting entry will be cash debit, debtors credit. And if the risk of the bad debt will be beared by the company itself, then the accounting treatment should be cash debit and loan credit. And from the exam point of view, the tip is examiner will always give you this case. Now, what about if the finance cost is? Yeah, you need to book the finance cost because you are recognizing the loan here. So you need definitely. Now the next part is IS 12. IS 12 greater than tax base for an asset, it says the difference will be taxable temporary difference. Taxation authorities are charging a depreciation of 60 initially. So their book value is 40. Now here you see the case. Sometime it will be given in the examination question, or sometime you need to calculate the tax base. In this case, the carrying amount is 60 and the tax base is 40. The rule is the tax base, the carrying amount is greater than the tax base, then the difference will be taxable temporary difference. So what's the difference? So here you can see the difference is 20. The 20 will be the taxable temporary difference. So taxable temporary difference multiplied by tax rate, assuming 20% is the tax rate. So there will be a deferred tax liability of 4. So the accounting entry should be income statement debit and DTL credit. So the impact of this DTL treatment because of the fact that this difference is arising because of the depreciation. And depreciation in the income statement. That's why the impact is also because of that's why the impact was also going in the income statement. So that's a very important point because the difference in the carrying amount of tax base is arising because due to the depreciation. Depreciation is an item of income statement. Therefore, its tax impact will also go in the income statement. But if if the carrying amount is 100 and the tax base is also 100, both are same, and we do the revaluation of 30, so the carrying amount will be 130. Taxation authorities never recognize the the revaluation gain initially, so their tax base will be 100. So again, in this situation, the carrying amount is greater than tax base, so there will be a difference of 30 taxable temporary difference. So when we multiply this 30 by the 20%, the amount will be 6. That is my deferred tax liability. But the accounting entry in this situation should be, I'm using this space, revaluation surplus debit and DTL credit. Will be 6. Why is the case? Because this difference between the carrying amount and tax base was occurred because of the revaluation gain, and revaluation is an item which will be reported in the equity. So therefore, its tax impact will also go in the equity, revaluation reserve debit and DTL credit. So this is one of the favorite point of the examiner, that you should know that which deferred tax will go in the income statement and which deferred tax will go in the revaluation reserve. So if the deferred tax is arising because of income statement items, it will be going in the income statement. And if the deferred tax is arising because of the equity related item, it will go in the revaluation surplus. We add the gain of 6. No, we deduct. It's not a gain. It's the tax on the gain. So the gain is actually 30 and the tax on the gain is 6. So the 6 should be deducted from the revaluation reserve and included in the total deferred tax liability. If you charge depreciation the revalued amount, then you need to calculate what portion is coming because of the revaluation and what portion of the difference is coming because of the depreciation. And the part of the tax that is related to depreciation will go in the income statement. The part of the tax that is related to the revalued amount will go in the revaluation surplus. But you don't need to worry about this. This type of questions can be asked in SBR. So I'm not going to explain this concept right now. Yeah. It should be less from the RR. Yes. Whenever we debit the revaluation reserve account, it should be debit the RR. Now the equation that I have mentioned, that is tax expense is equals to current tax plus increase in DTL. So do remember this point, when we take the increase in DTL, we always considered that DTL which is related to the income statement in order to calculate the tax expense. And we always ignore revaluation reserve related DTL for tax expense. We never include revaluation reserve related DTL for tax the calculation of tax expense. Plus last year's under provided tax. This SFP will be reported at 24. 30 minus 6 is 24. Okay. So do remember this point, taxable temporary difference will result in the creation of DTL, and deductible temporary difference will create deferred tax asset. It occurs when the carrying amount is greater than tax base for the asset, and this situation occurs when the carrying amount is less than the tax base. Deferred tax, remember this point, that deferred tax will arise because of the deductible temporary differences and carry forward unused tax losses. These are the reasons for deferred tax asset. So if you have no knowledge about the unused tax losses, that's a concept of F6. If you didn't study F6 yet, then just try to memorize this point. The deferred tax asset will arise because of unused tax loss. Now, here is a question for you guys, in which you are required to calculate the tax expense. So first of all, you need to know what is the current tax. Now, just read the point. The balance on the tax relates in the trial balance relates to the under and over provided tax. Under provided or over provided tax. So if it is on the debit side or if it is on the credit side. Over provided tax or under provided tax. Under provided tax means that in the previous year you have charged less tax but paid the more amount. So under provided will always appear on the debit side, and the over provided tax will be appear in the credit side. So if in the trial balance it's mentioned that the tax opening balance is credit, that means it's an over provided balance of the previous year. So first of all, you need the current tax. The tax estimate for the year 2008 is 2.1 million. So 2100 is my current tax. Over provided tax should be deducted from here, so it should be 130. It's deducted from here. In addition to this, there has been a decrease in the taxable temporary difference. So taxable temporary difference has decreased over the year by 2 million. And the tax rate is 25%. So there will be a decrease in DTL. So 2000 into 25%, it will be 500. So as I explained earlier, that increase in DTL should be added and decrease in DTL should be deducted from here. So the final answer for this question should be 2100 minus 500 minus 130. So amount should be 1470. Very good. Is it clear to all of you? If the opening was given to you, then there will definitely be closing balance as well. So you need to compare the opening and the closing value in order to calculate the deferred tax. Now this one is the second question for you guys. Please do attempt this one. Ignore this point. This will be discussed later on. Solve this part through the equation. So is it done? Assuming the tax rate is 10%. Now the tax expense will be calculated as the current year's tax will be 2,700. So you have been given under provided tax. So it should be added here. The opening deferred tax is 3,200 and the closing amount is 2,400, 12 million more than the tax rate. So 12,000 into the actual tax rate actually is for this question is 25%. 12 million into 25%. So it will be 3,000. Yes. So the opening value is 3,200, closing value is 3,000. So there will be a decrease in DTL of 200. So the amount that we should report in the income statement should be 2,700 minus 200 plus 700. The amount should be 3,200. Very good. Assuming the tax rate is 25%. Now, if it is cleared, then I need to solve this question using the T account as well. The opening deferred tax is 3,200 in this question, and the current tax is 700. The closing current tax is 2,700 plus deferred tax is 3,000. So when you calculate the income statement item, the amount will be the balance sheet figure, which is 3,200. So this amount will go in the income statement. This will go in the balance sheet as current liability. And this amount will be reported as non-current liability in the deferred tax liability account. You don't need to report the deductible temporary difference or a taxable temporary difference. If there's a taxable temporary difference, just multiply it with the tax rate, you will get the deferred tax liability. So deferred tax liability will definitely be reported in the balance sheet as a liability. And if there's a deductible temporary difference multiplied with the tax rate, you will get the amount of deferred tax asset. Okay, 25% was actually missing in the data. So that's why I recommend you to calculate at 25%. So that's the data which was missing. So that's why I just wrote it here. When you saw the question, you will get to know that 25% is the right answer. So that's the equation. I'm also making a T account for the tax. The opening balance can appear both on the debit and credit side. Similarly, the closing balance can be on the debit or credit side. The amount charged in the income statement should be reported here, and revaluation related tax will be reported on the credit side. So it will be having current tax and deferred tax liability. The deferred tax liability will go in the non-current liability at the balance sheet date. Current tax will go in the current liability. Similarly, if at the closing the current tax is here, that means the current tax is recoverable. It should be reported in current assets. And if there is a deferred tax asset at the closing date, it will be reported in non-current assets. So let's attempt the last question before closing this session. Mm, Now this for the we have already covered this part. So we have already done this. Okay, so now it's your home assignment because we have covered IS 12. Wait for 1 minute. Now this was the question. This was the handout available to all of you guys. If you do not have this handout, you can download this handout from the handout section. That's the name of this handout is J123 handout. Now you'll be having a trial balance in which we have covered note number 1 already. That is related to IFRS 15. Note number 2 is related to IS 37. Try to attempt this. Otherwise, I will cover this standard in the next class. Note number 3 is related to taxation. That's what we have already solved this part. Note number 4 is related to the convertible loan. This is what we have already covered. And note number 5 is related to the non-current asset. That's also covered. Note number 6 is about the fraud. The concept is very simple. The treatment is retrospective for all the frauds. And the last note is related to the suspense account in which the company has issued the right shares. So that's your assumed knowledge from F3. So based on this information, all of you are required to prepare the income statement, but you have to prepare this income statement and statement of change in equities from where you need to solve this question on the constructive response workspace. You can ignore EPS part right now, but you need to prepare the balance sheet and the income statement. Sorry, statement of change in equities and P&L. For the second question, when on, we have covered almost all the notes. You are required to prepare the P&L. Ignore the EPS area. The next question is Haverford. All of you are required to solve the P&L, statement change in equities and balance sheet. You have covered almost all the notes. So let's make it simple. I'm giving you just Haverford. Only Haverford and Duggan. So these are the two questions, Duggan and Haverford. All of you are required to solve this on the constructive response workspace. And you can check your answer. These are the questions of the past papers. And you have to send it to me on the WhatsApp personally. Just take the snapshot of whatever the question that you have solved and send it to me, the picture of that. With reference to MCQs part, all of you are required to attempt practice handout 1. That's the practice handout 2. That's I've already shared. And practice handout 3. And the answer of this practice handout 2 will be shared on the group tonight. So you have to attempt 2 questions. Do remember this point, Duggan and Haverford. And I have prepared the formats for the income statement. You can use these formats. These are the formats that you can use for the preparation of the financial statements. So it's very important to learn these formats and prepare the income statement and the balance sheet. I'm giving you 2 questions, ever code and the bill. So thank you so much for your time. And inshallah, tomorrow we'll be discussing the next topics. I have to cover 3 accounting standards, which is leftover. The one is IS 37. There's a student, Walid Khan, who was continuously asking about the concept of IS 37, IS 8, and IS 21. So these are the 3 short accounting standards that will be covered tomorrow. And then we will start working on the consolidation. So please do attempt these assignments. Don't you worry about the EPS. I will share the recorded lectures of EPS with all of you guys. But I have shared the cash flow video link. How many of you have attempted the cash flow video or have seen the cash flow video? And if it is done, then please do attempt at least 2 practice questions after that video. So please give your valuable feedback to ACCA about these sessions. These are specially designed for the March 2021 attempt. Please give your valuable feedback. And if you haven't joined the WhatsApp group, please join our WhatsApp group. I'm sharing my number with you. So you can contact me. And the management had shared the group link for the WhatsApp as well as my contact number. And inshallah, we will start the session tomorrow. So stay connected and we'll be having a very interesting session for the consolidation in the next class. Thank you so much. Allah Hafiz. To take care of yourself.